Well, good morning, everybody, and thank you for joining this month's webinar, Beyond the Field. Today's webinar will be on livestock risk protection with Danny Stratton from Farmers Union and Logan Stagley from Farmers Union. A few housekeeping tips before we get started. First of all, everybody is on mute for the beginning portion of this webinar just to keep down the noise. If you have any questions at any time, please feel free to type them into the chat or the Q&A. Both of those should be active and working now. If not, please type them or raise your hand. We will also open up the mics at the end for anybody that wants to talk and ask questions directly to Denny or Logan, which we highly encourage. Also, as I said, this webinar is being recorded, so if you want to rewatch it or share with others, it can be found when you type the Google channel, type in North Dakota Farmers Union. That's where you can also find our previous webinars that we have recorded, and then a follow-up email with this presentation and this recording will be sent directly to you a few days after we get this uploaded. I also ask that you guys please take the exit survey at the end of this webinar. It really helps us with improvements to these webinars and gives us content for the next month's webinars. So with that, I would first like to introduce Denny Stratton, who is a Farmers Union Insurance Crop Insurance Sales Director. Denny is located in Minot. He has been working for Farmers Union Insurance for the past 20 years. He first started as an agent in 2004, and since 2010, he has been Farmers Union Insurance Management as Crop Insurance Sales Director. He works with agents in North Dakota, South Dakota, and Utah. And then we also have Logan Stagley, who grew up in Center, North Dakota on a cattle ranch, so he's well expert in this area. He graduated from college from Mayville State with a degree in business management. Logan was a crops adjuster for 2 years, which led him into being an insurance agent. He is currently located in the Turtle Lake, McCluskey area. He also enjoys the opportunity to help farmers and ranchers protect their assets, especially working with livestock risk protection. So with that, before we get started, we're going to do a quick little poll for the audience, and we ask that you please answer these to the best of your ability. And we'll take a few minutes, probably like 30 seconds to 45 seconds to answer these questions. So if you guys are online and can take those questions, the first question is, what type of livestock operation best classifies you? And then, have you ever used livestock risk protection insurance? So we greatly appreciate you taking the time to answer those polls. And it looks like most people have answered, so we will stop sharing and take a quick look at those results. So about 42% of our a little over 50 audience is a cow-calf operation, and the next highest percentage is, or the most high is nobody with livestock at 46%. So gives you a good look at that. And then actually using livestock risk protection, over 60% of people have not used it. So they're in the right place to kind of know and learn about livestock risk protection. So with that, I will end the poll, and yeah, we'll get started, Denny and Logan.
All right, thank you. Today we're just going to start off going over a lot of the basics, just for any of you who are not familiar with it. Just give you a little bit on the rules and the procedures that we try to make sure everybody understands it before they just walk in to buy. But however, it is a really simple policy. I think that's the thing we liked about it the most, is we got to learn it quick, understand it well, especially for those in the cattle industry with a background in that, like Logan. But we really like it as an insurance company. We like PRF and LRP both. Ranchers really needed a policy, we thought. And we were watching them constantly improve it till it finally got to where it needed to be. Made it affordable. The coverage was there. Claims actually did get paid out. But the other thing too was they're self-sufficient kind of policies. So usually you're not doing what a farmer has to do with crop insurance. You're not running down and meeting your agent, going over acreage reports for hours. You're not running to the FSA and certifying acres. You're not waiting for an adjuster to come out. The claims are automatically generated because these things are based on one peril, and it either covers it or it doesn't. And if it doesn't, that means you're having a great year. Anything you want to add with that?
That one peril is market. So this is strictly a market protection policy. It's going to protect you for market decline. And like Denny said, the thing that's made this policy so appetizing is the subsidies that have been improved greatly in the last 3-4 years.
Yeah.
That have really brought this policy to light, and like Denny said, made it affordable. So and we'll go over all the details on it, and like Amanda said at the beginning, definitely open to questions. It helps us out a lot we can read off slideshows all day, but to get some questions from you guys would be we do appreciate that.
We're finally at that time where we've been working with it so much the last few years, and I feel like just talking to the agents every day, we're on a constant group chat, just a handful of us, myself and our livestock expert agents, just so that I feel like now after 3 years, we finally have heard almost everything you can hear for questions or rebuttals or issues or just strange scenarios now. So it's kind of nice to be at the point where we're actually hoping to hear a few questions, maybe some that we don't have the answer to, so we can learn something as well. I'll go ahead and start with the insurable livestock here. You saw in the last slide, mortality is not covered. Like Logan said, there's one peril. That's it, decline in livestock. That's all this policy does. So you're just going to guarantee your price, pick a coverage level, and let's say I want 99% of that trading market price, and that's it. If it goes below that, you get paid. There's nothing more to this than that. So we can go on to the next slide. Sorry, Amanda. Insurable livestock. This is the most common one, right?
Mm-hmm. Yeah, feeder cattle is in North Dakota. You get down into like Nebraska, Oklahoma. You start to get into the fats, and there are some of that in North Dakota. But this feeder cattle, this is going to be your most general cow-calf operation that we see in North Dakota. So this one we spend a lot of time on, and this is the one that has the most questions on. Not that we don't talk about fed cattle, but this one I would say is vast majority, and we saw that in the polling too. That majority is the feeder cattle cow-calf pair operation.
Yeah, that definitely makes it easier for us because that's where the majority of our business is. So we just kind of feel comfortable there. But I have had a lot of fun. If you want to look on the next slide here, the few times we did get to work with fed cattle, I actually enjoyed it. I wish we could run into more feedlots and more fat cattle operations, just because the quotes were really good. I mean, you've done them too.
Yeah.
Where there's sometimes you're insuring an animal for $2,400 and it costs $70.
Well, and we're just in a market now where we're finally graced with some fantastic pricing. They've never been higher. So it is very appetizing to look at this. I mean, I'm sure there's people in this audience that have seen, $1.50 calves. And to see that doubled it's fun, and it's good conversations to have with cattle ranchers because you get to hear the kind of happiness, as I would say, in their voice, because they're kind of finally getting paid for the amount of work that gets put into it, which is awesome. And that's why we're here, is to just make sure that you can get another year of these high prices, and continue to protect yourself as volatile as this market is. Amanda, if you could go back one, touch on that. So the feeder cattle policy, just to kind of break this, what you're seeing down, we have steers, heifers, dairy cattle, Brahman breeds, unborn steers and heifers, unborn Brahman breeds, and unborn dairy cattle. Obviously, in North Dakota, I don't see a ton of Brahman. But steers, heifers, and unborn steers and heifers are the main ones. With the unborn steers and heifers, that's actually ensuring baby inside of mama. And then steers and heifers are as soon as hooves hit the ground. And then there are the different weight classes, as you can see there. Six weight is our break point on that. Once you get over 6 weight, then you go into the heavier feeder cattle. Below 6 weight is your lights.
And you would say probably most of the policies you deal with lately have been people maybe insuring unborns, and just a calf crop they're trying to maybe sell in October, November, so it's probably under the 600. But you still run into some of those weight twos, don't you?
Yes. Yep. Yeah, we do weight twos. It's for those guys that market in the February, March timeline, when you are seeing that 7.5 to 8.5 pound calf or 850 pound calf. If you buy that unborn policy, some of those guys are looking at, well, I'm leaving 250 pounds uninsured if I buy this unborn policy, and that's where it's key to talk to someone specifically about your policy, an agent that's working with it, so we can actually tailor this to your operation. But the majority is, yes, the unborn steers and heifers that and the lighter cattle are what we generally write. So yeah.
All right, let's look at the next one. There is the fed cattle, right?
Yep.
I mean, you can get up there pretty heavy in weight. Obviously, it's going to follow the typical rules. So we get up to that 1,600 pound, and that's where it kind of tapers off. But I think that's just got to follow suit, right?
Yeah, and fats. Once you get into fats, you do group steers and heifers together. So you don't have you're not picking just steers, just heifers, separating them out like you would on a feeder cattle policy. Your steers and heifers are grouped together on your fats, and then you're getting into that, like it says there, 1,000 pounds to 1,600 pounds. So.
Okay, and on that slide too, there used to be sheep. We've been getting a lot of questions on that lately. People are trying to get in on this on sheep. They used to have it, but the market just got a little wild for trying to figure that out, how to set a correct rate and balance, because it was just more volatile. And we'll go into what the volatility factor does here in just a little bit. So,
and you see swine as well. So if there is any swine producers or anything, we can talk about it. I don't run into a lot of swine. Again, I grew up on a cattle ranch, so my background's in cows. I showed pigs, and that's about the extent of pigs that I want to deal with. But I can dig into it.
You know, swine are fun too. They're kind of like running fed cattle. The coverage is good, the price is good. It's just you're working on lean weight instead of live weight. So that's one thing we're always trying to remind everybody when they're looking at these things for swine. We gotta know a little more accurately on the lean weight. And I figured that would happen anyway, just because of the way they market and sell them.
Right.
So,
right.
Okay, next slide. All right. You can get through any approved licensed agent out there. They have to take their tests. They have to be certified. They got to make sure they know what they're doing. My suggestion is find somebody who's been doing this a while, or maybe has that background, grew up in the cattle industry. It kind of knows the business end, because they're really going to help you try and optimize your policy and get things locked in at the right time, I would say.
And just understanding what operations are. I mean, it's as simple as talk to a lot of people that they don't understand when these cattle are marketed. So it's nice talking with someone that lives it and has seen it and has been in the industry for a while.
Okay, who is LRP for? We're going to do this one on feeder cattle. I'm really glad the poll showed that, because we hate making assumptions and have it not work out, but this is we were right. Yeah. So like we said, it's going to be for anybody taking 1,000 pounds or less. So you're going to have your weight ones up to 600 or 599, we'll say,
Yep.
and then your weight twos go up to that 1,000. But the main thing is that little bold highlight you see right there, ownership share.
Mm-hmm.
You know, the thing we do run into every now and again is a lot of, maybe, do I want to say handshake agreements, things like that, where people do get a piece of ownership off the cow, but it might not be on paper.
Well, case in point, I run 20 head and I'm on a 30% share with my dad. And it's not on paper that it's that way. So whenever it comes to a policy like this, and I'm looking at it for myself, the way the insured share works is if you got 100 head and you got 50% shares, you insure 50 head, not 50% of 100. So it's a little bit different approach. Once we got it figured out, it's obviously a lot easier, but it caught us a little off guard when we're like, well, that's which 50 are insured, and you kind of get into the weeds there a little bit, but we break it down. If you have an operation like that, we can explain to you how your policy would be structured in that case. So
yeah, I would say it's kind of tough. Most people are used to the crop insurance deal where you have a 50% share of the crop, so you pay half the premium and have half the coverage. Where here they're not doing that; they just split the herd up.
Yep.
So yeah. You want this one?
Yeah. So how the policy works, you come into me or any licensed agent to sell it and explain your situation, what you got. Basically, you say you got 100 head. I always like using 100 head. Just it's easy math. You come in January and go over how many head you have. Find out when you kind of market, what your target weight's going to be. So say you sell in November at 550 pounds is your average weight. So what we do, if you're doing the unborn policy, you'd buy the unborn calves at a 550 weight, and you pick a date. It goes in week increments. It goes in 4-week increments, and you can go all the way out to 47, 50,
52,
52, 53.
Yeah, and we'll show that here in another slide.
Yep.
I think the thing that we try to remind everybody is all these prices and all these coverages that you would get from your agent, they're set based on Chicago Mercantile Exchange, and they're using a weighted average. Okay.
The 5 main big boards. We use CME as our main hub, but there is the 5 big boards, and they take the total off of that. And so they set the price. RMA sets the price. We don't get to pick that. RMA picks the price. They set it when market closes at 330 roughly. It's been. And once that price is set and closed, that's when we go to work. That is when we have numbers we can provide to you. I've sold a lot of these policies at 8, 9 o'clock at night because that's the only time we can sell them. Once 8 a.m. rolls around the next morning, we're shut off and we got to wait for markets to close that next day. So what you do, you pick your, like I said, you pick your date, say it's 11/15. That once you lock in an endorsement, for 11/15, you lock in a policy. You locked in $280 for November 15th. You're done with that policy. That is in place. There's no changing of it. You select the amount of head that you want on that policy, and then once 11/15 rolls around, whatever the market is that day, that's what we're basing it off of. And again, that day 11/15 is selected by RMA to what the pricing is on that day. So you locked in 280 and CME locks in 270, and we got $10 is our difference there.
Yeah, so that last paragraph that shows that weighted average, that's what they're saying there. On the crop insurance side, they'll dictate what the commodity price is worth that year based on spring, maybe. Okay, so they'll take every day in February on the trading days and they'll average that out and say that's a spring price. Well, here you're picking an ending price based on a weighted average too, but it's a little more simple than that.
Mm-hmm.
It's 7 days.
Yep.
Yeah, 7
Yep.
trading days around the date that you pick for about the time you want to sell.
3 in the front, 3 in the back, and then the day of.
Perfect. Thank you. Well, this is yours.
Yeah. Now we so the big thing is when you're looking at cattle markets, CME, when you pull up CME boards, the main number that you see is sometimes different than what our quote is. And that's because typically the CME is most of the time basing their price off of a 7.5 weight steer. So for that, and this is, again, I'll touch on this too, just because we're in price. Cash price is going to be different than national average. I get that question a lot where guys say, well, the Napoleon barn is at 340. Why the heck are you giving me a quote for 315? And it's like, we're going off of national average. There is a premium on northern cattle. You guys just must, we raise them good up here, and everybody wants them. So our cash price is usually a little bit higher. But this is going off the national average. So to give you the difference and the higher premium on lighter calves that you would get at a sale barn, we use a price adjustment factor. And so on the light cattle, steers are at 110% factor. So what you'll do is you'll take that CME number, say it's 286, and you would times it by 110%, and that's your price adjustment factor. And on heifers, the light heifers, it's 100%, so it's dollar for dollar with what the CME is on lights. And then predominantly Brahman, dairy, 100% and 85%. And then once you get up into the heavier calves, you got 100% steers, because that's when you're getting into the national, or that's you're in the weight class that they base the national prices off of. Heifers get into, they go to 90%, because heavier heifers, they don't bring as much as a heavy steer does. So and then Brahman and dairy 90% and 80%. So that's how the price adjustment factor works. Like I said, we run into that a lot where guys are saying these numbers don't match up with what the computers tell me. Well, that's why we do use a price adjustment factor to give you that advantage on light cattle, because they do bring more.
Coverage levels. We talked about this. You're basically locking in a percentage of your price. So the thing is, it's kind of like on the crop insurance policy, you'll see this too, where the higher your coverage level, the less subsidy is paid. And when we say subsidy, we're just talking about that is the government participation in your premium. So if you had 100% coverage level here, and just for fun, let's just say it costs $100 for round numbers, your share, that would be $65. The rest is already covered. It's kind of funny because we are seeing more people now that these prices are so high. We are seeing people just to lock in something safe. This never happened before until probably this year, maybe last year, mm-hmm. where people were buying lower than 99 or 100% coverage. They said, you know what, if I buy 80% or 85, it costs me way less money, and I'm still guaranteeing $1,500 per calf. I'm okay. That's my disaster coverage. I think that's okay too, but I feel like they're just missing out on some opportunities above that too. So I always like to show them both, so they can see, even though you pay more premium, when you're guaranteeing that much more money, it actually washes that out. So,
yeah. Okay.
So Logan was talking about this. You can buy anywhere from 13 weeks to 52 weeks. It's setting on when you want to actually sell your calf crop. So a lot of people will tell us, oh, it's too late. I should have talked to you last spring, or oh, I'm way too early. I'll come talk to you in a couple months. Well, you'd be surprised. I mean, when you go 52 weeks out, there might be something there for you. So don't be afraid to just shoot a quick message to your agent. And I mean, people do that to you all the time, don't they?
Yeah, and what a lot of guys do is they'll let me know what their calf crop looks like, what they're expecting, and when they want to market. Now, the thing about feeder cattle in LRP is you don't have to sell them. So we talk about sell date and everything like that. The only reason why we talk about sell date and why we talk so much importance on it is it's going to play the most true to the policy. You can select any dates you want. Anything further and you start getting away from when you actually project to sell your cattle, you're starting to gamble quite a bit on what the market's going to do. You can play that game if you want. We've talked about it a lot. We like to set it up as close to sale date as you can. Like I said, you can do what you want with the policy, and you start getting into target weights and stuff. The further out you get, it gets messier. But so you bring in, like I said, bring in your operation. Let us know what you got. We'll put you down on our contact list if you would like to get updates. And I send texts every single day on market updates and where we're at on pricing. So get a point of contact, have that dialogue open with an agent, and have the ability for them to go to work for you. And that's probably the most important part that I think. You can go on the.
Well, it's okay. The last bullet point there says available to buy all year long in all states. I wish I would have added another detail to that, and that's tomorrow.
Right.
Can't buy tomorrow. It's available every trading day.
Yep.
Okay. So there is certain holidays, there are certain time zones you just cannot buy. And then Logan's probably better at explaining this than me, but there's also the time frame. Say you want to buy on Friday, that's not a holiday. You have to treat it like a weekday, right?
Yeah, you have to have that policy locked in and sold by Saturday morning. It's not open all weekend. So we have to have our information into our insurance provider by 8 a.m. the next morning. And the other thing too on this, available by all year long, available in all states, we talked about it a little bit earlier, that it's not always available to us. There is, if the market is very, very volatile, the RMA has every opportunity that they want to shut this policy down. And we just saw that with when the tariffs hit and we got into that kind of dip in the market that we saw last week, 2 weeks ago. That we actually got shut out of this policy for a little bit, and we just couldn't offer anything because it got so volatile. So if you see that market hit a point where you're like, this is the time to do it, just do it, lock it in. You'll sleep at night. It'll be comfortable. We're at a market price now where we are in a very good spot in the cattle world. You could wait 3 days and get $2 more and play that game, or it could tank. So it is, if you know your operation, you know your books, lock in when it's a number that you're comfortable with, and maybe it is move your coverage level down a little bit to, instead of locking in $3, you lock in $275 just because that's what you're comfortable with, and that's a little less premium on the board. And on top of that, I keep getting on tangents.
I know you do.
I get excited about LRP. I'm a geek.
Let's check the next slide here. Go ahead.
I was just going to say, with LRP2, the premium that is due, it's due at the end of the policy. So it's not up front. I'm not writing this policy up for you and say, here, give me a $2,000 check. This is due 30 days after the policy end date.
Yeah, good point. So here's just a brief example of how the coverages and the prices are calculated. Now, bear in mind here, this is not even close. Like, this is one example we got from some of our crop carriers, and this was a while back, but it's just a good way so you could actually see the math on it. We do have, Logan put some stuff together to kind of show you what more current coverages and prices are, but you'll see here, rancher has 1,000 head. He wants a weight twos at 700 pounds was when he sells, and it shows a coverage price of $220. So he has $1.54 million worth of coverage, and when they go to sell, maybe the price dropped $10, and now you see that there's $1,470,000 there. So the last payment was $70,000. That's just a simple understanding so you can see how it is. I know Logan did explain it earlier, but I also think people need to see it sometimes before we get into the quotes, just so they could see how you did what you did.
Works.
Yeah.
Yep.
We can go ahead. Okay, benefits. we'll do that real quick. We have more here too that I always forget to put in the bullet points because it just gets too wordy, but guaranteed price, your limited risk coverage there. You got lots of endorsement period options. You saw that earlier, and you can pick different target weights. So that's kind of a big deal too. I think it's easy for you to tailor the policy that fits you. The thing too is there's a lot of flexibility in this policy. A lot of people are so scared that I said I sell on November 15th. I can't get to the barn then, or the price isn't quite right then, or gosh, it was a dry year, might be a little low on weight, things like that, right? So, but there's a lot of flexibility in the policy, don't you think?
Yeah, well, I talked to my guys too about it. It's not, you're not contracting your calves, but you are. So it's giving you, the thing LRP does is it's giving you a floor on your calves. It's setting, this is kind of, once that market time rolls around, we never use the word guaranteed because like I said, if you decide to buy this policy in October and you don't market till December, you can run into some hiccups, but typically you're not going to see a huge decline in if you're a week here or a week there in the front and the back. But so just having that reassurance that you have protection on your market, and there's no penalty for it. There's no, you sold your calves higher than what your LRP price is locked in. We're not coming back to you saying, oh, you sold $20 higher, we want 5 of that. No, it's, you pay your premium and you're covered for what your ending value is. There's nothing else to it. So there's no catches to it like you would see maybe in some other contracts, or some other buying options that are given to you from elsewhere. This is a black and white policy. It's right there for you, and that's what I like about it, is there's no gimmicks to it, I guess.
Yeah, I agree. And going back to the flexibility, I guess one thing I always like to remind people, they're worried about getting their sales date right or getting their target weight right. You know and have a good idea of what you're going to average for weight, and it's going to be up and down, and I mean, everybody knows it's not a perfect system, so that's not as big of a deal to worry about. And also, as far as like when your sales date is, you actually got a buffer in front of and behind that sales date of up to 60 days if you run into a real problem. So it's a really flexible policy. We just say don't abuse it. Keep yourself in that nice spot of when you're going to sell roughly and the weight. That way, if you run into any hiccups, you have the ability to utilize the flexibility of the policy.
Well, and on feeders, you actually don't have the 60 days behind. It's just the front. So.
Oh yeah, sorry.
Yep. That's Denny's in fat cattle mode. But on the feeder cattle, you can actually retain those. So we get the question a lot: commercial versus registered. This works for anybody that's got cattle. You can retain your cull calves. You can hold back your replacement heifers. Those calves can be on this policy. So that's what I like about it. Is it's not, you don't have to take your feeder cattle to slaughter. You don't have to sell them at a barn. Now, once you get into the fat cattle policy, there is that requirement to sell those cattle for slaughter.
Yeah. All right, we can go to the next slide here. Just real quick, a few improvements. I feel like Logan and I have already covered all this, so I'm not going to read this off to you. You can offset your premium. So if you have a claim payment, you can get that taken out. Like Logan said, back in the day, you used to have to write a check and hand it to Logan on the day you bought it. Now you don't have to do that all the way until the time of your ending date. So that's kind of nice.
Yeah, hopefully you got your calf check at that time to help pay for premium, because our market's skyrocketed and you got paid a fortune for your calves.
Yeah, and the clarify that livestock must be marketable by the end of the policy. Now it's pretty simple, really. When somebody has a claim, they bring their sales barn receipts in, right?
Yeah, sales
and
receipt.
You send it in for
them. Yep. If you don't sell it, I've had guys send me vaccination records that they bought. So many so many doses of scour guard or whatever they're vaccinating their cattle with. So everybody's got different things that they use on their operation, but say you buy 100 doses of whatever, that's has worked in the past for proving you still own those cattle. So easiest obviously is, if you sell them at a sale barn, provide the sales receipt so that we know the number of heads sold. That's the real important part that a lot of the claims people look at, is the number of heads sold. So
good.
Yeah.
Okay, next slide. We went over a little bit of that too. There's some of that written. I mean, you can insure quite a few heads, so I'm not going to beat that to death there.
We're just talking ahead of our slides.
Yeah. So even what we were talking about when we were saying that the subsidies have improved, I mean, it was kind of wild there for a while. We're seeing a really big jump now, and I think that's why we're getting so much more interest in it, is not only the value of the cattle higher, but the fact that the premiums can be paid later. And basically, the premium is going to get paid if you're doing really well and you made more than what the policy stated, or it's going to get paid if you didn't and you locked in a higher price. So that's really been helpful too. So let's go ahead and go to the next one. Okay. Hey, just a quick deal here on a lot of people ask us things like, what happens if I have to do what we did years ago when we had a terrible drought and maybe I just did not have the feed? I had to dump my herd in July. We've been lucky enough, knock on wood here. I think from what I saw in the history of it, they've been very good at honoring the fact that you had to do that. So you got to pretend you kept your herd all the way until your sales date, maybe in November, even though you sold them in July, and keep that policy alive. So that really helped a lot of people that year. So,
well, and what the 60-day ownership is, we touched on it. I'll just dig into it right here real quick. Is you can't sell your cattle 60 days before your policy end date. And so what this does, this drought prevention allows you to do, is open that up. If you sell prior to the 60 days, 61 days I had someone do, you pay premium and lose coverage if you sell before that 60-day window. So what this does is it opens up that availability to not hit you with that if there is a drought because you ran out of feed.
Yeah.
So
good point.
So Denny and Logan, what considers that the drought? Is that like the national declaration, kind of like they do for drought for crop or hayland?
Yeah, that's how it was done. It was done by county and how it was declared in that manner, which I think it was almost everywhere here a few years ago.
Terrible.
So I know that's a worry for a lot of people this year. So
Thank you.
okay, we're not going to spend a lot of time on this really blurry slide that I made. Sorry, Logan.
No, it's good.
Yeah, this was an example, and I've used it in other presentations with you. A lot of these slides have been, but then we've changed up a few. But the thing is, on this one, this is when we had some COVID worries, and everybody decided we should look at it. So we just started running quotes for people just to make sure we could help them in any way, shape, or form. And it wasn't that good. I mean, I look at it and it's $130 actual ending value. So
And we're up over $2 now.
yeah, it's way over that now. But I just wanted to say there was people actually looking at buying this and paying, gosh, they're paying almost more premium for half the coverage. So that's gone. We can move on to that slide because that is out with the old. I just like to remind people that didn't have it, that were panic buying then because of that.
And so this one, this is my ad.
I'll let you read this one. How about that?
This one, me and Denny toyed back and forth about if it was going to be too hard for you to read or not. So if it is, I apologize. I can give you these numbers in person too if you need. But the main thing to look at here, there's a lot of numbers. I want you to look at end date, coverage price, and producer premium all the way to the right. So what you're looking at here, this is the 4 different policies that we're offering. I don't have unborn steers and heifers on here, so that is not included in this. But what you're seeing is, this is actually a live quote. I did this yesterday. So what you're seeing here is 2 November dates with the 2 different coverage levels, 90%, 100%, and then December dates too. So what you're seeing here is you're seeing how the coverage price lies with the coverage level selected, 90% and 100%. So if I'm looking at the top left, the type is, this is for heifer weights 1. I look at these every day and I got to remind myself that you guys don't, because I fly right through them. But on the top right there, Amanda, if you want to drag your cursor, it says type heifer weight 1, and that's at a target end weight of 599 pounds. So what you're, like I said, what you're looking at here is your end date in November and coverage price at the coverage level, and then your producer premium. So it's just showing you, this is showing you live numbers, and you really see what that subsidy factor does going from 100% to 90%. So if it is, you're not super comfortable going all in on the amount for premium, there, like we talked about earlier, there is those options. And I've had conversations with bankers too about this, is what's kind of a break-even number on your calves. You know, maybe you don't want to maximize the number that you're locking in at. Maybe you want to just set a break even, and anything over that you're comfortable with. That would be where a case would be that we would run a 90% quote, or lower. We can go even lower. So it's really important just to discuss what operations you have and what's going to fit you the best. And like I said, on this slide, you're seeing the light heifers and light steers, and heavy steers and heavy heifers. And so you can kind of see here what everything's running at current price. As I said, this quote was ran yesterday. What coverage price you're locking in at for each individual cow or calf. And then the heavies, I did 7.5 weight. So you're seeing 7.5 weight steers, we're locking in at $2,100, a little over, which is a fantastic price. So I guess this one too, I know if there's any questions on this stuff, please type away in the chat, but and we can tailor these numbers to anyone that needs it at any time. So
okay, let's look at the next one. You can go to the next one. We kind of covered this really well, and I see we're burning up a little time. Here's one thing I will say: if you're ever wondering at all, just work the Google feeder cattle futures. You'll see it'll show pulp CME's chart right there. And just remember, like Logan said earlier, if you're just trying to insure your steers, you're going to add 10% on that, and it's going to be pretty close. They'll be in the ballpark of what you're expecting when you get a quote from your agent or from Logan. Heifers will be flat with that number roughly. I mean, this is give or take a little bit. It's always moving and whatnot, but I bet by the time you get your quote after 3:30 that day from Logan or your agent, you'll see that it's pretty close. All right, we can
probably open up Q&A.
Yeah, I think so. I think a couple things I had wrote down. You can't look at this one. I was going to surprise Logan with a bunch of questions on left field in case anybody else didn't do it. You know, a couple hurdles I want to say you want to watch out for is time. You know, if you get a quote and you say, yeah, I really liked what I saw there last week at that 290, I think I'll buy it. That's not going to work. We have to completely rerun that. So remember, we're working for you all day, watching the markets and whatnot. And then 3:30 comes out, and if it's looking good, we're going to let you know. But we got to have something done. I like to say 8 o'clock the next morning, so we have time to get things processed and whatnot. So time is always kind of the biggest hurdle. I always tell everybody, if you can make your life a little easier, try to just create a policy with your agent so the policy's in the system. It only takes a few minutes, but that's a few minutes you don't have to worry. And then just keep looking at the markets and getting quotes from your customer. And when you find a price you really like, you're comfortable with, then you just let them know. The beautiful thing about this policy is it's kind of seamless. If you have a policy already created and you see a coverage amount you really like, you let him know we can do everything. You could be on the bar cabin and you can get an email on your phone and you can do accept and sign right there, and you accepted that endorsement for that price amount.
And that's the thing. When we set up these policies, setting up a policy does not cost you a dime. It doesn't lock anything in. It just gets you approved through RMA.
Yeah.
So that's what Danny's talking about, and the importance of just set up a policy, have it all in place, have your compliance good, that you've been approved by RMA to buy it. And then once that time comes where a price is comfortable, you can lock in that endorsement for that actual coverage price you want.
Yeah. Another quick hurdle, make sure you're compliant. Sometimes we have some ranchers that haven't certified with anything with FSA, maybe their hayland or their grain. If you haven't done that, go in and make sure you have an AD 1026 form signed. That helps keep you in there, and then you get the subsidy on your premium. Otherwise, you're 100% premium. Another thing too, we try to tell everybody there's a thing called the volatility factor, and what that does is as the grain markets are going up and down a lot, the wilder they get, sometimes the higher your price will be for your premium because it's just getting harder to rate for it. So I was telling everybody, if you pick a price that you really like and the market's been sitting pretty stable, pretty flat, that seems to be the best bang for your buck, for lack of a better term, right?
Yep.
Okay. Another hurdle, be careful. Logan talked about it. They can throw a moratorium on it and just cut coverage. If the prices get really wild, take a big dive or a big jump, and it's never permanent, but it might be a time where you really wanted to buy and it might be too late. So that's another reason why I say pick a price you're comfortable with and lock something in. Do you want me to go into the death stuff, or should we're running a little low on time here?
Yeah, sure. If there is death loss, you just got to notify us 72 hours after a death. And we can get into that detail too if you got more questions regarding it. Whenever you speak with your agent, just bring it up. But it's a 72-hour window. If there is a death, you need to let us know.
All right, perfect. Well, we can open it up for chat now. Again, you can type it into the Q&A. I have unmuted everybody, so you should be able to, or everybody should have permission to talk. You just have to unmute yourself if you would prefer to ask directly to Denny and Logan. To get us started off, Denny and Logan, how does this LRP work if I have bred heifers? Is there any cautions or anything I have to worry around when I'm doing bred heifers?
Do you want that one?
No, you go right ahead on that one.
So bred heifers are not allowed in this program. Once you get into, as we touched on before, once you get into that fat cattle, that is where you are buying a policy for a marketable animal. That animal is set to be sold, and bred heifers just don't fit that mold. And it's a very, you get into a very gray area of the policy, and we've just been flat out told that bred heifers are not allowed on the policy, is what we've been told.
Okay, we did have one chat be typed in question. Your statement about letting you know within 72 hours of a death, that is only if you're assured 100% of your cattle, correct?
Yeah, yes. Yep, pretty much. You hit the nail on the head as far as if you got 100, if you're insuring 100 head and only insuring 50, unless you lose 51 calves, then it would get into that. But yes, you are 100% correct. If you are insuring 100% of your animals, that's where the death loss comes in.
And the thing about that death loss is if you let your agent know in 72 hours, you get to keep the policy on that animal, even though it's not alive anymore. You get to, you still get charged premium, but you still get the coverage.
Yeah.
We still try and make suggestions for people with unborns if they know their stats on what their death rate might be. It's like if you cap out 100 and you don't like insuring an animal that's not breathing, maybe insure 90.
Yeah,
right?
and I think most average North Dakota average is 3 to 5% death loss. So that's kind of what I base all my numbers off of. There's obviously winter storms that change that a lot, so it's not always a perfect science. But when doing unborns, I like the 3 to 5% just right off the bat. Anything further than that is where you need to go. But you are 100% right, Jason.
Another question. As you were kind of talking about drought, and I think you related to this, but maybe you want to just cover it again. But so there's a good possibility there's going to be a drought again, and a lot of producers are going to be selling their cattle ahead of, that because they don't have enough hay or feed. So if I sell before the end date of my LRP insurance policy, what will happen?
So we touched on that a little bit earlier, but yes, in detail a little bit on that. So if you sell before 60 days, coverage is void, premium is due. Probably the most black and white answer on that one is yes. If you sell 60 days prior to on a feeder cattle, on fats, it's 60 days before and 60 days after. If you don't sell fats, and if you do sell feeders before that 60 days, your premium is due and coverage is void.
But on the drought part, it'd have to be declared.
Oh, on the drought side, yes.
Yeah, it'd have to be declared, by our superiors and government.
If you have a policy, we will make sure you know that is opened up, and they are very evident about that, and make sure to let you know. And then I see Zane had a question here. After hours product, do you need to come into the office to sign up? No, you do not. We can do everything electronically. And I've had phone calls. I've FaceTimed ranchers' wives before to walk them through on doing e-signature and stuff. So we will figure out a way to get it done. And you do not have to be in our office to sign up for this. We can do everything over the phone and online.
Another question. Oh, if you want to answer it, Logan.
Yeah, Carla. So if insured contracts cattle, can they still buy LRP? Yes, you can. If you have a contract through a cattle buyer or anything like that, as far as we've been told, yes, that plays no role on buying the LRP policy on top of it.
Again, if anybody has any questions, feel free to type them in or speak aloud. I have unmuted everybody, so you just have to unmute yourself. So Denny, I guess this may be a question more for you. Do any of the Farmers Union insurance agents sell LRP?
Yeah, we have, I would say probably a dozen in the state right now. Just a handful. It's not for everybody. Not every agent really grew up in that background or really lives in that kind of area where they're comfortable with it. But it's actually a really simple policy. But we've got every corner of the state and all of the middle covered really well, so that if there is any producers out there, we can take care of them. What's nice too, Logan was talking about, you have to be in the office. We can do it remotely. That's really been handy because there's a lot of times people will start wanting to buy while they're calving or right before they're calving, and maybe they're nowhere near us. So we just help do all the heavy lifting on our end, so that all you do is maybe hit sign submit on an email. So.
Perfect. Well, I know we can still answer it for questions, but I think you kind of covered already some of these tips and ways to go around with LRP, right, Denny?
Yeah, our slideshow is done.
Yeah, and I know there's some additional resources here that Denny and Logan referred to kind of understand LRP and where some of those numbers come from for the market. So those are always helpful. And again, this presentation will be emailed out to everybody. So um,
And that's just the last kind of thing to touch on too before we wrap up. If there's no other questions, is you know your operation the best. Contact someone that knows this policy the best and meet together and figure out what's going to work best for your operation. We can talk till we're blue in the face about specifics of the policy, but until we actually know what you guys are working with, that's the best option, because we can, like I said, we can fine tune comb your operation and figure out scenarios that are going to work best for you.